Hi there, everybody. It's Joel here at Trading Group 101, and today just wanted to kind of put together a short video and a little bit of a discussion. This isn't so much as a chart analysis, this is more about talking about the macroeconomics around oil at the moment, and there's been some developments over the past couple of days, namely the implementation of the Russia oil price cap. So we're going to talk a little bit about that, and I'll also write it in the description below so that then you can either listen to this or you can read through it at your own pace, depending if you want to listen to the sound of my voice or not. So what we're looking at really is, as I say, the interesting new development where it's an ongoing struggle, as we have all been aware, unless you've been living under a rock over the past 12 months, between the West and Russia, and a major flashpoint in this is around Russia's distribution and selling of oil and energy prices overall. So many of you already will be aware that the West, I say, have been trying to put pressure on Russia by limiting the availability of Russian oil on the global markets. Now, it's really difficult to actually do this practically, as Russia, of course, can set its own prices for oil, and customers can, of course, pay the prices that they want to for that. So it's difficult to directly put pressure on the price of oil, in a direct sense. The way that the West has actually done this, though, is because they run a monopoly, mainly through Germany, in fact, on shipping insurance. So every shipment of oil needs to be insured. For one reason or another, things could go wrong, and essentially, customers won't buy oil unless it is insured, because, of course, it costs many millions of pounds, and euros and dollars to buy these shipments of oil. So unless they're insured, of course, nobody in the right mind is going to start buying them. So through using this monopoly of the shipping insurance, the West is able to implement this price cap, which basically means that all of the insurance companies for oil and for shipping insurance are not allowed to insure any shipments from Russia above $60 a barrel. So what does that mean? Well, as it currently stands, probably not a huge amount, because interestingly, Russian oil is actually already trading a little bit below $60 a barrel. So it's not yet clear how much of an impact this will actually directly have on the oil price, but it does raise an interesting question of why would the West set a cap at this level? Well, the answer, it seems, is that they've calculated it in such a way that it provides just enough incentive for Putin to keep pumping oil, because the West is understandably concerned that Putin might choose to remove Russian oil from the international markets. This would, of course, cause a price rise significantly, and if global oil prices do rise much above where they are currently, I think that that's where we will start to see this oil price cap become a bit more of an issue, and some of the tit for tat and some of the confrontation around this will, of course, rise from there. Now, it's just, of course, one issue, one example of the complex dance that goes on between petronations and the West. Because on one hand, the West wants to have the ability to put pressure on petronations, especially geopolitical reasons such as the invasion of an ally in Ukraine. But the reality is that petronations such as Russia, they have the power to put significant pressure back on the West through energy prices. So it's a delicate balancing act, and it's not always clear who will overall get the upper hand. But what does this mean for the future? Well, as I say, it's difficult to say for certain, because it's unpredictable to see exactly what Putin's response to this will be. Of course, on one hand, from Putin's perspective, he needs to still be pumping oil and still needs to be selling oil, because that's a major part of the Russian economy. But equally so, he can't be seen as weak within the domestically. There's a whole political argument around that, but also, of course, as well, he wants to be able to charge the going rate for oil that he's selling. So there's all different ways that this can play out. But of course, there are many other factors here at play here as well, and it's not, it's impossible to predict exactly how things will unfold. But one thing I think is clear to say that is if we start to see if we start to see oil globally, so here I'm on the chart of US oil. If we start to see this rise back up to where it has been, if we go back here, just only a few months ago, back into the summer, prices were well above $100 a barrel. So if we start seeing prices rise 20%, 30% from where they are right now, of course, then that has an impact on Russian oil prices. And if they're already at the cap of prices at the moment or just below it, if we see a 20 or 30% rise in the price, then it's quite clear to see that that is where things will start to get heated. So if the price of oil continues to fall globally from where we are at around $75, then I don't think this really will have too much of an impact on markets. However, if we start seeing prices move up back towards the $100 mark, anywhere I think beyond $85, $90, then that's the point where things are going to start to get heated, and we'll actually start to see a little bit more of this becoming an issue. And then that's where things have become really, really dangerous for oil markets, because if then at that stage Russia did retaliate, start removing oil from the global markets, that then creates an even larger supply and demand imbalance. And that's where things can really start to get silly and start to put prices into levels not seen for a long time since. So that's just kind of a summary of what I wanted to kind of put together for you today, and just kind of go from there. Really, let us know in the comments what your thoughts are on this, if it's something that you've been following, and it'd be great to hear from you guys as well. So all the best. Speak to you soon.